Most traders are happy if they can find a trade that gives them 2 or 3 to 1 risk reward. They consider that a home run. But imagine what your P&L would look like if you could start putting on trades with a risk reward of over 10 to 1. Well, with the power of options, you can do just that. In fact, one of our young star traders put on such a trade in Meta recently. The risk reward was 13 to 1. And in this video, we break down the trade and teach you how to find and put on trades just like this. So check out this video.
Hi, I'm Seth Freuberger, and I'm the head trader of SMB Capital's Options Trading Desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Most traders have been watching the train wreck known as Meta stock, which announced almost exactly a year ago on October 28th, 2021, that it was changing its name from Facebook to Meta, and that it was going to be pouring a huge amount of resources into basically creating and ultimately dominating the metaverse, a shared 3D virtual internet space that's considered to be the next generation version of the internet. And they've subsequently poured billions and billions of dollars into this effort. And as you can see from this price chart, since the day of their announcement, when the stock was trading over 300 through to the day before earnings were about to be released last week, the market has not exactly been enthralled with this idea and has in fact greeted this news with a slow, tortuous sell-off of Meta stock down to about 129 on the afternoon before earnings were to be released. A loss as of last week of about 60% of its market cap since that time. And that was before earnings were announced on October 26th. And so with such a high profile stock performing so poorly, naturally each earnings event is going to be a pretty big deal. And this is just the kind of situation that day and swing traders love to get involved in. Now, in today's video, we're going to review a very simple strategy for playing Meta's earnings release, which is actually loosely based on a trade made by one of the guys on our desk. And there are some really important lessons that can be drawn from the strategy we'll be teaching you. Now, before we get into the details of this trade, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price that you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, so since this is a video about buying and selling put options derived from Meta stock, we need to make sure that everyone understands how put options on stocks work, and this is going to be quick for those of you who already know how they work, so just hang in there. Okay, so what's known as a put option on a stock entitles the buyer of that put option to sell 100 shares of a stock that he owns at a certain price called the strike price of that put option, regardless of what the price of the stock is actually trading at when he exercises that right. The buyer of the put option pays what's called a premium to the seller of the option, because the seller of the option is taking the risk that the stock will go way below the strike price of that put option, in which case the buyer can exercise his option and force the put seller to buy his shares at the put option's strike price, which is higher than where the market's trading, causing the seller's account to get marked down. So even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell 100 shares of that stock at the strike price of that put. So he'll get a way above market price for those shares by virtue of owning that put. And so the premium of the put option reflects the risk that the market thinks the put seller has, that the shares will be going much lower than the strike price of that put. And so all other things being equal, when a stock price goes down, the price of a put option for that stock is going to go up, because the put seller's chances of taking a loss, because the market has blown through his strike price, gets larger as the stock's price continues to drop. On the other hand, if the stock closes above the put strike price on expiration day, the put expires worthless and the put seller just pockets the premium he got for taking that risk in the first place. Okay, so with that said, let's head back to the afternoon of October 26th, the afternoon immediately preceding the after-hours release of Meta's earnings for the third quarter of 2022. And as we mentioned, Meta was trading around 129. So suppose that at that point, a trader were to have pulled up the options chain that expires on Friday of that week, just a couple days later, October 28th, and suppose that he went ahead and bought 225 of those Meta 100 puts, which are about 29 points below where the stock is trading. Now, those options are pretty cheap because they're located 22% below where the stock is trading, and there are only 3 days left for those options to expire. And so this is clearly a directional call on the trader's part that he believes that the market will sell Meta off hard after earnings, which of course may or may not happen. Okay, so the total cost of these puts is easy to calculate because, as we mentioned, they were cheap, 25 cents per options contract. And remember, each options contract represents 100 shares of stock. And so you multiply that by 100, and he bought 225 of those. And so the total cost initially on this trade is $5,625. Okay, so now this is where it gets interesting. So let's move to the next morning. And as you can see, Meta stock fell off a cliff. It seems that the market hated Meta's earnings report and its aggressive spending on its metaverse build out, and the stock plummeted the next morning, opening below 98. Now, this is decision time for the trader because with the sell-off on Meta, those puts have become really valuable. They have gone up from 25 cents to $4.17, as you can see on the options chain. So it'd be tempting to just cash those in and close the trade at that point, which would be a perfectly valid thing to do. However, some traders might look at this situation and conclude that the market is so negative on Meta that it could sell off even further before the end of the day. And so let's see what would have happened if the trader instead sold 1/3 of those 225 puts. In other words, sold off 75 of them, but then at the same time opened a new position selling 150 of the options at the 90 strike price, almost 8 points lower than where it opened. And so when he's finished executing this transaction, the position actually looks like this, with 150 remaining of the original puts at the 100 strike and 150 new short puts located at the 90 strike, forming what options traders refer to as a put debit spread. Now, let's break down what's going on here so you'll understand why a trader might have done something like that. And to do that, let's take a look at the cash flow implications of this trade adjustment that the trader just made. And so starting out with the proceeds he received from selling those 75 puts, you can see that he got a price of $4.17 for the 100 puts, way more than he paid. And again, you multiply that by 100 shares it represents, and the 75 puts we sold to arrive at a gross proceeds of $31,275 just from selling 75 of those original puts. And additionally, he also brings another $6,300 from selling 150 of the 90 strike puts, as you can see from the calculation. Now, subtracting out the original cost of the 225 puts, you can see that the position has now turned positive cash flow by $31,950. But in the meantime, let's move to 12:15 p.m. that same day when Meta had rallied back a bit over 100. And so I want you to take a look at the price of those 90 puts that we sold in the morning. And as you can see, they're only priced at 3 cents, even though we sold them in the morning for 42 cents. And that's because with Meta having rallied back over 100 and with the options having less than 3 days to expire, the market's not willing to pay much for those 90 puts, which are likely to expire worthless in a few days anyway. And so what solid professional traders do with risk management skills, what they do at this point is to buy back and close the short 150 puts at the 90 strike for 3 cents a piece. And so at that point, the cash flow picture has changed, of course, but very slightly. And as you can see, adding the cost of buying back those 150 puts, which was just $450 versus the $6,300 we received when we sold them earlier in the day, buying those back drops the positive cash flow down very slightly to $31.5. And now, so after we remove those 150 short puts at 90, we are just left with the original 100 strike puts, but now we've got, of course, 150 of them, which were, of course, the remainder of the original position that we put on the previous afternoon. Okay, so now moving to the end of the day, Meta had closed at 97.94, down more than 30 points from the previous day's close. And so if we were to close the trade at this point, the 150 remaining puts would be worth $2.99, which makes sense because the owner of those puts has the right to sell Meta shares at 100 when they're worth 97.94 in the open market, and there's still time left before they expire. And so the market is saying that they're worth nearly $3 when we paid 25 cents for them originally. So if we close the trade at this point, as you can see from the calculation, starting with the proceeds from those first 75 puts that we sold on the open, and adding to that the cash we received from selling the 90 puts on the open, then taking off the original cost of the 225 puts and the cost to buy back all of those 90 puts around noon, and finally we bring in from cashing in on the remaining 100 puts that we kept until the end of the day, which was over $44,000. The result is a gain of over $76,000, which is more than 13 times the cost of the original 225 puts, a risk reward that any day trader will take all day, obviously. And so what I'd like you to take away from today's video is the fact that options trading, perhaps more than any other trading style, provides risk-reward trade-off opportunities that really rarely exist in any other context. It's not easy to find 13-to-1 reward to risk situations with equity trades, for example, but those kinds of opportunities actually exist all over the place in the options trading world. Additionally, as happened in this case, if the trade goes your way, you're in the driver's seat, and you can actually take off enough lots at that point to both guarantee that you'll make a solid profit out of the trade no matter what happens, while giving yourself an opportunity to bring in additional profit if the stock continues to move your way, as happened in this case where the trader picked up over $40,000 of additional profit by keeping 2/3 of the original puts while he locked in at least a $31,000 gain no matter what Meta did after that. It's that kind of skillful training that professional traders possess that allow them to lock in solid profits while keeping ample opportunity open for much more profit if things break the right way. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we are currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now before you miss it.
So now you know how to put on trades that offer asymmetric risk reward. But these trades don't come every day, and it's tough for many to find a consistent living just on these. So what most need are smaller but more consistent risk-reward trades. And to know how to get those with options, you need to watch the video appearing on your screen now, which will teach you about earning weekly income through options. Click on it now to learn how to do just that.